Kingsley here, and welcome to another RBA and Economic Update. It's an exciting time, Melbourne Cup Day, and as usual, I'm joined by Evan Lucas, and we're going to dissect all the data from around the nations and also take a deep dive on the Australian data. So, g'day, Evan. How are you, mate?
Good, mate. I'm looking forward to taking a couple of bets today. I know we're going to have a bet on the horses, but also probably have a bit of a bet on what happens with Aussie rates over the year. So I'm very clear and very happy to sort of be talking to you on the biggest punting day of the year about things that I know more about than horses.
Well, yes, I mean, I know nothing about that sort of four-legged sport as well. A couple of big themes that we want to sort of get into. Obviously, there's been a bit of rate movement in the US, so we'll touch on that. China, we've got a little bit of a story to tell there. They just can't kickstart that economy. Europe's obviously seeing rates come down, so we've got more to talk about there. And then we really are going to take quite a deep dive into the only data set that matters in Australia, and that is the inflation data. So we're really going to prosecute an argument, and you and I have got a little bit of a differing view in terms of where interest rates are. So we might take a little bet on that, and then we'll round out all of the traditional data that we normally touch to. So I can't wait. Let's get into the show, guys. And thanks for joining us for the show. So let's start like we always do in the mighty US, and we know obviously at the time of recording this, it's very close to the election.
Isn't it? Technically, today's the day. I mean,
today's the day. So
tomorrow,
it's true. It's tomorrow their time, or today our time, or the other way around actually. But it is also fascinating in terms of we may not have a result for several days.
I don't think we will. I think we need to point that out. I think you need to be very ready for the fact that the swing states, the big seven, so Wisconsin, Michigan, Pennsylvania, North Carolina, Georgia, Arizona, Nevada.
You've done well there. You've done very well. Yeah,
I'm a massive US political junkie.
Yeah.
I would argue that 3, maybe even as much as 5 of them won't get called on the day. And if that's the case, you won't know who the next president of the United States is probably for several days. Do we have a 2000 where obviously we had the Al Gore, George W. Bush scenario where, he went to the Supreme Court with Florida.
Well, Gore won, but then basically, because it was going to take months in the courts, he stepped down and ultimately we had George W. Bush Jr.
Yeah, so it's going to be very, very unstable for that period of time. So just be aware, tomorrow when you wake up, the US probably will be quite an interesting scenario.
Yeah, now unless also something's happened, in the last sort of 7 or so days that have moved a lot of voters, the markets are tipping a Trump victory on those swing states, and obviously the Electoral College votes that he needs to get to, he's tipped to get to the magical, I think, 274, and looks
270.
Like 270, and ultimately
334 is you need 270, and away you go.
So look, I mean, obviously that from a geopolitical point of view, and also in terms of what that means from an economic point of view, is yet to be seen. In terms of what that agenda might look like, we've got more to say about that. So let's rip into the data. We want to start firstly with the inflation story in the US. And we saw there that there was no GDP number, so we're moving straight into this data. And we saw annual inflation rate in the US slowed for the 6th consecutive month to a reading of 2.4% in September. And now that's the lowest since February of 2021 and down from the 2.5% reading that we saw in August. Now, these figures came in above forecast of a 2.3% reading. Now, prices rose less for shelter and energy costs. And then we also saw prices continue to fall in new vehicles and new cars sales and trucks. Now, on the other hand, we saw inflation accelerated for food and transportation. And in a month-to-month basis, the CPI actually rose by 0.2%. And that's the same as in August and above a forecast of a 0.1% rise. Now, then we look at annual inflation, core inflation we're talking about here. The rate unexpectedly edged up at 3.3%. Compared to 3.2% in the previous 2 months, while investors were expecting it to stay at 3.2%. The monthly core inflation rate remained at 0.3%, and that's the same in the August numbers, but above a forecast of 0.2. Evan, what did you see in the US inflation data?
Yeah, so we're going to talk about this a lot, the difference between September and October. Now, I know the data we're talking about is the difference between August and September, so bear with me with regards to how I talk about this in time, but it's the first time since the last time we spoke that you've actually seen the expectation of rate cuts when a cut has happened in the US go the other way. So what you might have seen in the media over the particularly last 3 or 4 weeks, is the 1995 event, which is where Alan Greenspan was doing something similar, basically to what we're going through right now, which was to cool the US economy. It was
Yeah.
booming along, and he cut rates, and he was cutting rates. But the inflation data showed, along with the GDP data, that actually he was achieving a soft landing. So the expectation of how much he needed to cut evaporated quite quickly. And that's what's happening this time around. This is why we're now hearing more and more about the US actually could have not just a soft landing, but a decent soft landing. So by the end of the year, when we last spoke about this, you and me, Ben, we was talking about 4 rate cuts by Christmas in the
Yeah.
States. So they did a big 50 bit, which is on the screen right now. That's pretty much almost evaporated. There's a chance of one by the
Yeah.
end of the year. And so the data you just read to, particularly that core figure jumping back up, it's not necessarily coming back to the 2%. They don't have a band like we do. They have a flat rate at 2%, is why. But also, again, we've not seen since 1995 the US Treasuries move up, and it was 15 basis points in the 2-year, which is the one everybody concentrates on,
Yeah.
since 1995. So from my perspective, they're not done. I need to point that out very clearly, but the pace at which they're going to do it may have changed.
Yeah, I think that's also, I mean, interestingly enough, in the actual Fed minutes, the officials were uncertain about the extent of the
Mm.
interest rate cut, but they did opt for that 50 basis points or half a percentage point cut during that particular debate. And there was actually one of the actual members, uh, exceeded from the actual main group in terms of saying that they only wanted a 25%. We hadn't seen that happen for a long time in terms of what that looks like. But then Jerome Powell came out in his press conference also saying that the 50 basis points reduction should not be interpreted as evidence of less favourable economic outlook or a
Yeah.
signal that the pace of policy easing would be more rapid from this point forward. So the board still believes, to their point, that inflation was moving sustainably towards that 2% target. So, because a lot of people reacted to the 50 basis points as an emergency
Yeah.
cut compared to when we've seen those types of cuts before.
Yeah. So it will be, and again, we spoke about at the start of this, the unknown is also the election. So all of
Yeah.
those things are part and parcel with where and why the reaction from the last meeting to where we are now, things have changed in those 6 weeks. And it will continue to develop in terms of how that is. So we watch this very closely.
Yeah, and I think one of the big things while we saw that 50 basis points cut was the story around the unemployment and the readjustment. And we spoke about that at our last update about how the numbers were so wrong. So let's look at, what we saw in the unemployment numbers, because they've been a little bit stronger than most people expected. So we saw the unemployment rate in the US fall to 4.1%. So it's actually falling in that September reading, which is the lowest in 3 months, and it's down from a reading of 4.2 in the previous month. And it did surprise markets in terms of just how
Mm.
strong that unemployment reading was. So we saw the number of unemployed individuals decrease by around 281,000 to a reading of 6.83 million, whilst employment levels also increased by 430,000 to a reading of 161.8 million. Meanwhile, the labour participation rate was steady at 62.7, and the the employment population ratio increased to a reading of 60.2 from 60 based on the US Bureau of Labor Statistics. So it's actually, normally at this sort of time in the cycle, you're not actually seeing unemployment come down when you're seeing an easing in the rate cycle this
Yeah.
early. Yeah.
Well, we also got to remember the recalibration that's happened this year. It's for the first time, and I can remember in a long, long time. GFC was when I last saw something similar. Was the non-farm payrolls being this out of whack?
Yeah.
Like having to see them recalibrate by about 69 to even as much as 120,000 jobs per month is staggering. So the average is 69,000 jobs difference between what was initially reported and the recalibration from January through to June, which is why that chart on screen is so out of whack, as you're pointing to there, Ben. That 4.3% unemployment rate is probably more what people thought it should be, and then it's recalibrating back again. So there is some people that are suggesting you need to take the non-farm payrolls in the current cycle with a pinch of salt, as the data is clearly something's interrupting it. And even the
Yeah.
Bureau themselves have said that there is seasonalities that we haven't seen before. I also want to just get everybody out there remembering that figure Ben read out about participation. 62% of the employable population in the US is in this survey. Australia is at 67 to 68.
Yeah.
That difference is extraordinary in that amount of people, which would also argue that this is probably wrong. The unemployment rate is definitely higher
Higher than
than
that.
what's been reported.
And I think that, I mean, because, talking about the election, one of the things Kamala Harris should be able to talk about is that we've got a great economy. It's the biggest economy, and it's growing, and we've got record low unemployment. But to your point, people feel less, less happier or less well off in the economy right now. And that's probably because they're not putting their hands up and going out and trying to get a job.
Yeah. And that's why if you look at the welfare numbers and those that are claiming welfare, they are still near levels that we saw at the end of 2021. Not at, COVID peaks.
Yeah.
But they are significantly higher than trend.
Yeah, and so you just wonder whether if they, with all of those adjustments to your point, adjusting it up by 120 odd thousand, whether the Fed board had that data, whether they would have dropped that additional sort of 0.5, 0.25 as opposed to the half a percentage point that they actually dropped. So interesting. All right, let's move on now to talk about the consumer confidence and sentiment. And so this talks more to, how basically people are acting and feeling and behaving in the economy. And so we still see this, in a sort of sluggish territory from where it's been in recent times. So we saw the University of Michigan Consumer Sentiment Survey for the US decline to a reading of 68.9 in October, and that's at a 5-month high from a reading of 70.1 in September, and that's below the forecast of 70.8, which was the preliminary estimate. Now, that's both the current conditions and also the expectation gauge is weakened as consumers continue to feel frustrated over high prices was the analogy and assessment of this sort of consumer sentiment reading. Let's now see how that's correlating into retail sales. And what we saw there, looking at the retail sales now, we saw there was an increase of 0.4 month over month in September. Now, that's well above the 0.1% gain in August, and it beat market expectations by a rise of 0.3 of 1%. So that's a pretty solid number when you're thinking about sentiment still being, where it is. But, like these sorts of things, they can be a little bit patchy in terms of, you can see as per the chart, they can bump up and bump down a fair bit. So I'm not sure I'm reading anything more into the fact that consumers are still spending, but their rates is still, below longer term averages.
There are some people that are arguing that that's also the effect of a rate cut. So there
Yep.
is some people that were pointing out that look what rate cuts do. They do give more money in people's pockets, and away you go. Don't forget also, though, in the US that their home loans are fixed forever.
Yeah. So it's a small percentage,
But
but
it's a very small percentage. But some were trying to allude to that. I'm not necessarily buying it, but I do want to present to you that there is some views out there that the
I
rate
think
cut
sentiment plays
is
into that.
confidence.
Like it's just, it's that belief system that we're over the worst of it, and so it's not an immediate wealth effect. To your point, that takes a little bit of time to flow through. But I think there's maybe a case for that. Let's look at the business confidence now. But this is also the other piece, right? When you have such a big tightening cycle and you sort of see how that plays with the broader economy, I think there was a lot more optimism at the start of the year than where we finished in the middle of the year, thinking that they were going to interest rate cuts earlier. And then obviously they didn't cut with inflation, staying a bit more stickier. And then so all of that momentum falls away. I talk about this flywheel, or that flywheel catching the water is slowing down. And we saw that in the number. So the IMS manufacturing PMI was a recording of 47.2% in September. And that's the same as August, and it's slightly below forecast of a 47.5. This reading continues to point to a contraction in the manufacturing sector, which now extends to 6 straight months, as we're seeing in the data. Demand continues to be weak from output declines, and input stayed accommodative. So in other words, hopefully those input costs mean that being accommodative, they're not necessarily going to be inflationary as they flow through into the end product and prices. A decline was seen in new orders, inventories, and backlog of orders, whilst production's nearly stalled, prices eased, and supplier deliveries indicated slowing deliveries. So that broader demand now working back through the manufacturing area is definitely showing up. It was also reported that demand remains subdued as companies showed an unwillingness to invest in capital and inventory due to the federal monetary policy. And guess what? The election uncertainty.
Mm-hmm. I'm going to preempt what we're going to talk about when we get to Australia with this chart, because I think this chart is going to use for my backing for my bet.
Yeah, okay, fair enough too. I think you're right. But
Right.
I'm also saying, because we're going to have this bet about where rates are going.
Where rates are
Yeah,
going to go.
yeah,
This chart is why Australia next year, I believe, is going to replicate what the US did this year. Maybe
yeah.
not as long, but the expectation for rate cuts in the US was to start in March, and we had to wait all the way through to September. And
Yes.
business confidence, as you can see, was peaking off this idea that they were going to get a rate to the races, that the break was going to come off, that the expansion was going to be therefore coming. And the longer it took, as you can see from that chart, the longer and longer it got, the more and more fall in confidence happened.
Well, I can tell you, in looking at some of the future data we're about to talk about, there is also a further case for profits improving in the Australian side
Yep.
of business. So that says to me that, there's people are still out spending. So we'll talk to that shortly. So let's wrap up the US and see what we have as our key takeaways. We saw, obviously, that rates on their way down. The speed of that is obviously, and the timing and pace still remains uncertain. So instead of getting 4 rate cuts by the end of 2024, we're not sure where that will land. And then obviously at the Fed's next meeting, they will have potentially a new president in waiting, because if Trump has his way, I don't think Jerome Powell is going to be on his.
Despite him being his appointment.
He's not going to be his appointment, so that could also play itself out.
That's what's fascinating. He was his appointment in 2016. He won't be his appointment next time around.
That's right. Sorry, I jumped into China a little bit earlier there, but
perfect.
Here we are now looking at China. Now, China is a big story for us. I mean, we've sort of said it's been a bit anemic in the past, but we're now starting to see, more pumping of the fuel in the fuel tank and trying to get this engine started. So let's just start with the GDP numbers, and we saw the Chinese economy grew by a seasonally adjusted 0.9 of 1% in Q3. And that's after a 0.7% increase in Q2. Now, this was the 9th straight period of quarterly rises, supported by recent government initiatives aimed at stimulating consumption, mitigating deflationary risks, and reversing the downturn in the real estate sector. Speaking of that stimulus, and we did mention a little bit of this in our last meeting, the People's Bank of China in September launched this aggressive stimulus package to try and stimulate the economy off the back of the COVID story, but they still need to continue to keep looking at that. So they did some significant rate cuts, which we'll talk to in a moment, and also in terms of the overall plans that they have about trying to get the struggling domestic economy moving forward. And that's going to be a really challenging piece for them, because the consumer's not happy, and ultimately, businesses in terms of exports and all that also aren't playing well. So we'll move into what did they do. We saw them take that monetary policy decision. So let's recap what they did. They moved the monetary rate down. So the 1-year loan, the loan prime rate, the LPR, the benchmark for most corporate and household loans, was cut by 25 basis points to 3.1%. And the 5-year rate, which is a reference to the property mortgage rate, was also reduced by the same margin of 25 basis points down to 3.6. And the lending rates were cut, these lending rates were cut last in July. And here we are again with these cuts also happening in this time period. So, Evan, what did you make of the China story right now?
Yeah, the disappointment that happened in the 6 weeks since you and I have spoken. So you can look at the back of the envelope calculation with the previous chart that Ben had up, which was you can work out they're not going to reach 5% by the end of the year. If you look at that quarter on quarter, you can use the back of the envelope calculations, the quarterly numbers that are there. They're not going to make it.
No, they need to have a 1 in front.
Correct, and they're not there. They're saying they need to be near 5%. That's great political spin and something that all parties do. Yet what was, we had Golden Week during October. So don't forget, Golden Week is an interesting one. It definitely stimulates discretionary, but things stop for 10 days.
Yeah.
Things stop. So again, it just makes it even harder in this quarter that we're currently living through to reach that additional stimulus they need to get to 5% GDP by the end of this calendar year. And then the other disappointment was they cut rates in September, as you've got on screen, but there was expectation of actual monetary supply. So seeing money come in. There was even at one point, JP Morgan and also Citibank had outdone themselves with this incredible expectation of upwards of 3 trillion Chinese yuan. So about 250 billion US dollars into the economy. Zero. Got nothing after Golden Week. And so the Chinese economy is in this push-pull factor between President Xi's fiscal policies and the financial regulatory prudent stuff that he put in 2018-19 that he is so doggedly sticking to, and then the need of the economy and the fact that China realistically does need to grow at a minimum of 5% per annum to sustain the way that it works. This is a real concern from an Australian-centric perspective. The China story is a bigger story that isn't getting enough attention. It is in some markets. We don't normally talk about this. The thing to concentrate on, the Aussie dollar was on track to head towards 70 cents by the end of the year.
Yeah.
Since China's come back from Golden Week, it's at 65 cents and getting worse. And that's twofold. It's prospects of rate cuts in Australia. We'll talk about that later. But realistically, it's the China story and the Chinese outlook. And we are the proxy play for it. And the world is telling us China in 2025 is going to be a problem.
Well, and also, I mean, back off the back of those JP Morgan stimulus sort of papers that were released, everyone was expecting that the iron ore price was moving back towards that 125 a ton. Now, it's still holding reasonably strong, and we know that obviously there's a boom of electric car manufacturing and a demand for steel up there. But we would expect that the reason why ore would get to that sort of price level is only off the back of further stimulus out of China. So if that doesn't come, there's going to be downward pressure on the ore price in terms of what we see there. Let's have a look now at the unemployment rate. And we saw, the unemployment rate in China fell to a reading of 5.1% in September compared to a market sentiment estimate of in August reading of 5.3. So it's dropped down. It hasn't beaten market estimates and also the 5.3% reading that we saw in that time. So that then bleeds into what we saw in terms of retail sales. So, the data is quite limited that we get out of China, but here's what we talked about. The increase in retail sales was 0.39% in September over the previous months. And it really is anemic, in terms of that. So we would expect, based on what you're talking about in terms of the festivities happening in October, that we'll see a spike in that, because ultimately that's what we're trying to see. But that's got to be the trigger, doesn't it, Evan, in terms of if they don't have a big sort of celebratory festival spend, and they're not seeing that consumer spending, they're going to have to do something.
Yeah. The only other thing that may save them, inverted commas, in retail sales is Singles Day, which is in midway through November. But again, you can't rely on a one-off event to save yourself from where we're going. So the China story is one that will be something that you and I are talking about quite a lot in 2025.
Love it. Okay, let's look at business confidence now. And we saw that the business confidence numbers, the official NBS manufacturing PMI in China, rose to a reading of 49.8 in September. That was up from the 6-month low of 49.1. And that was surpassing market estimates of a reading of 49.5. While marking the 5th consecutive month of contraction in factory activity, the latest results was the softest decline in the sequence. So, they're sort of saying that they're looking for any type of positive news there. In terms of output, grew the most in 5 months, rebounding from a fall in August, while new orders shrank for the 5th straight month, but at a slower rate, continuing the challenging story for China businesses in terms of foreign sales fell by a faster pace as well. So exports are slowing, confidence is down. We're still, we're not in a growth territory at a reading below 50 in terms of productivity. So it's not a good story for China. So let's sort of give our key takeaways for China. What do we see? The government's going to have to do more work in terms of kickstarting that domestic economy. That's the real story there. And, the other big story that we were talking before about a Trump presidency, if that does come to pass, then ultimately we know what, sort of Trump's agenda is, getting all those jobs back into the US, into those rust bucket states, and trying to get some of that manufacturing happening again. So that's going to be, tariffs and worse story for China exports, isn't it, Em?
Yeah, and so it also just on that key takeaway around Trump and the US and possible tariffs, etc. It also brings into our next segment, which is Europe, and that is in the last week and a bit, you've seen Germany put tariffs on Chinese EVs, and as we
Yes.
speak on that, right now, Europe has actually sent delegates to China to try and also offset the probability that they're going to retaliate in terms of where they sit, because if you didn't see last week, for the first time in living memory, basically since the Second World War, Volkswagen, for example, is actually starting to show signs that it's under real stress.
They're
Is
closing factories.
yeah,
Yeah.
closing factories, talking about a 10% cut in its workforce. And in Germany, their trade union laws are incredibly tight, and also asking their workforce to take a haircut on their own pay. So this is the next part of this discussion, is that China's getting it from the US if Trump gets in.
Yeah.
It's getting it from Europe as well. And then the next thing is if that's all happening, we are the proxy to that again. And so let's move on to Europe, because I really think it's a fascinating scenario what's going on in Europe at
Well,
the
and,
moment.
and it also highlights to me that protectionism does not work, and it's
Yep.
long-term
Yep.
inflationary. So let's rip into that. So here we go over into the eurozone. It's obviously plenty of activity happening over there. We'll start with the first piece of data that we have around inflation, and this is the good news story coming out of the eurozone. So we saw that the inflation data in the euros area was revised lower to a reading of 1.7% in September, compared to the initial estimates of 1.8. Inflation is now at April 2021 lows and below the ECB's target range of 2%. We did see also services inflation. This is the great news story also coming out of there, which slowed, is great news for that market. And obviously, in terms of what I also love about what happened over there, those energy costs fell at a significantly fast pace. So they're quite disinflationary, which is really good. So on the other hand, inflation is steady for non-energy industrial goods and rose faster for food, alcohol, and tobacco. Annual core inflation, which was what we're going to be spending plenty of time talking about here in Australia, which excludes those energy, food, alcohol, and tobacco prices, eased to 2.7%, down from 2.8%, in line with preliminary estimates. And amongst the Eurozone's largest economies, we saw inflation eased in Germany, 1.8 versus 2, France 1.4 versus 2.2, Italy 0.7 versus 1.2, Spain 1.7 versus 2.4. So there's plenty happening there. And sort of before I get you to comment on that, let me just sort of unpack what happened in regards to what the ECB then did in terms of lowering its three key interest rates by 25 basis points in October, which was as expected following those similar moves that they did in September and in June. So the deposit facility, which is the main refinancing operations, and the marginal lending facility rate is now down to 3.25% and 3.4% respectively. The decision stems from the updated assessment on inflation, the improved assessment of inflation, which is just looked at, and which now is disinflationary, is progressing well in terms of what's happening in that particular market. Over to you, Evan.
So the advantage that Christine Lagarde and co had was that the concern back in May was that after that initial cut in June, that we saw a jump back up in inflation, and that maybe they were ahead of the curve and blah blah blah. Inflation has now told you it is broken.
Yeah.
They've broken the back of it and they're under control, but they now have to get on with it. They now have to stimulate and stimulate quickly. So we've now seen 75 basis points out of their rate in the last two meetings alone. And realistically, they're not done. They are far from done in terms of what they need to do to get the Eurozone ahead. So just spoke about Germany and where they currently sit. We'll go to the GDP figures in a minute, but I just want to stay on the point. Germany managed to stay out of a technical recession only by the barest of margins, and the largest economy in the zone to be skirting that issue will be a concern for Frankfurt in terms of what the ECB does going forward. Because if Germany basically splutters, the rest of it will more than splutter, it will cough and stop. So Europe's the other interesting scenario, because don't forget the big three, Germany, France, and Italy, they are manufacturing powerhouses,
Yes.
even though you wouldn't think they are. They are still manufacturing powerhouses facing the same problem that China is, that they are facing a Trump presidency that has made it very clear that they want to put tariffs on exports from the European Union as well. The next thing that's also unknown is the cost that could be put onto them with what's happening in Ukraine. Trump has made it also very clear that he will not fund the Ukraine war anymore once he gets to power. So you've got this scenario also now where you've got a prospective United Nations member and a prospective EU member without funding to actually defend itself. That will fall back on those big three. And the one that can crack there is Italy. Italy has made it clear that they're getting a bit concerned about funding it. They've got a government that also is far right. So there is a lot of interesting things geopolitically that is feeding into our world that I know most sort of technocrats don't need that headache.
Yeah, I mean, obviously, we've seen the Q2 GDP numbers. I didn't put the slide in because we don't have the
It's not there
Q3
yet.
data yet in terms of what's coming out there. But it is going to be fascinating because if we then take a look at, obviously, the consumer sentiment story, it's improving, but it's still in deep negative territory. So we see, in terms of looking at the data, consumer confidence in the euro area increased by 0.4% to a reading, 0.4 points to a reading of 12.5 in October. And this is the highest since February of 2022. And it was as expected off the back of those lower interest rates movements. In terms of, it still remains obviously quite below the long-term average there. So it's still, it's a thawing Europe, but we're still not necessarily sort of out the other side of what that looks like. And we can see that here in the business confidence. So with all of that sort of backdrop of protectionism policies and not being able to export those resources, we're seeing business confidence in the euro area decreased to a reading of negative 0.76 points in September from a reading of negative 0.62. So I'll say that again, negative 0.76 points in September from a
Those
negative
S's.
0.62 points in August. Whilst the interest rates, are starting to ease, businesses are taking a bit of time in terms of believing the story. And because, if they can't export their goods, they're not going to make those investments. And that's what's going to hurt the Eurozone as part of that particular story. So it's not a good outcome there, Evan.
No. And
all right, let's move on now to talk about the key takeaways. And so we can see here rates cuts are definitely a good thing off the back of those lower inflation stories. We're definitely seeing good services inflation is disinflationary, especially those energy costs that I mentioned earlier. But it is, based on that sort of consumer confidence and also business confidence, it's still going to take some time for that easing cycle to wash through into improved economic activity. But to Evan's point, that geopolitical stuff that's also going on doesn't necessarily mean it's a fait accompli that we're going to see that economy start to move and grow into positive territory. So it might just be bouncing along the bottom for a while soon.
which it has been for ages.
It has been. Okay, now here we go. All eyes are now on the domestic economy. And obviously last week we had the inflation data coming through, so everyone's anticipating, hopefully, a move in terms of what's happening with interest rates. But we want to start, obviously, with the inflation story. You said we were going to do a deep dive on this. Mm-hmm. So let's begin in terms of, let me unpack all of the movements that we saw in the quarterly data that we got last week. So our annual inflation rate, it dropped to 2.8% in the September quarter from a 3.8% in the June quarter. That's a tick. Okay, now this result was definitely steeper than market expectations of 2.9%, which, as I said, was that positive news. Now, in terms of that, was the lowest reading since Q1 of 2021, with goods inflation sharply slowing. So that's 1.4% versus 3.2% in Q2. Now, this was led by declines in electricity, in fuel prices, amid the continued inflation impact of the government energy bill handouts. So that's why we're seeing the actual main reading of inflation at where it is. But meanwhile, the big problem, which is service inflation, still remained elevated. To your point, Evan, 4.6 versus 4.5. Mm-hmm. So not much going on there. Let's take a deeper dive now in terms of looking at some of the different sides of the ledger. So on the good news side of the ledger, we saw alcohol and tobacco, in terms of falling prices there, clothing coming down, housing coming down, health coming down, financial services coming down. But there's still some big numbers in there, to your point. Like if we look at tobacco, it's still at 6.7 versus 6.8. The good news story in here is the housing 2.8 versus a 5.2. Health is still at 4.8, which is nowhere near our target range. And also financial services down from 6.4, but only to
6.2, isn't
6.2,
it?
right?
Yep.
So that's not great. Then obviously in terms of the transport costs also fell for the first time since Q4 of 2020. So that's finally cheaper oil prices sort of went through the bowser. And we finally had disinflation of 0.9 of 1% versus 4.6% from that previous quarter. So that did a lot of the heavy lifting when it came to obviously the overall rate. The bad side of the ledger, inflation was steady for food at 3.3%, whilst cost accelerated for recreation, 2.1% versus 0.9. Education was 6.4% versus 5.6%, and household services crept up by 0.7 of 1% versus a negative 1.1%. In terms of the most important measure is the core inflation measure. So I'm trying to get to that, but I've got something over my data
The
here.
other one I'm going to highlight while you're doing that, Ben, is childcare. So childcare year on year, 12.3% increase in terms of that space,
And we just had a big pay rise for all of our healthcare
workers. So that was the one that really caught my attention. You've went through all the ones that also are there. So what also needs to be reminded here is that these are the businesses that we talk about when we hear the word service, right? So services increasing from 4.5 to 4.6. This is where we're going to get to our little bet in a minute with regards to where we think rates are going to go in 2025. Because I've said this many times on this program, and I'll be saying it many times into the future. We are a service-based economy. It is the part of our economy that drives us going. It is the part that you have more interaction with than pretty much anything else. And you would have heard a lot of talk about goods. Look at how good services inflation it is. Yeah, goods inflation is at 0.5 of 1%. That's great. All fantastic. Not only that, from the peak, so on screen, that's 7.8% to where we are now at 2.8. 4.7% of that change is because goods have fallen by that amount.
Correct.
The difference of the 0.3 left is services. Services has not moved an inch since the peak. And this is the concern the RBA talks about with sustainably back to target.
There's those words, sustainably back. So let's have a look now at the core inflation data. So I've been able to get a little thing out of the way there. So this core inflation or trimmed mean CPI moved down to a reading of 3.5 in Q3. And that was aligned with most consensus, but it still exceeds the central bank's 2 to 3 target range in terms of where they need to get to. So I'm going to bring up this next set of slides, Evan, because this is going to tell the incredible story and the challenges that are being
where
faced.
I got to absolutely nerd out on all of this. So you can tell when I talk about this how much I love to talk about it and just how much it nerds me out. So first and foremost, this chart here, you keep hearing and comparing Australia to what's happening in the rest of the world. The rest of the world's cutting rates. Ben and I have literally just spent the last 40 minutes talking about what's going on in every other part of the world. And yet you've got to remember this, as Ben's highlighting with the mouse right now, Australia is significantly, and it doesn't look it, but it is significantly above the rest of the world. The nearest player to us is the US on core inflation at 3.3%. Don't forget, the US federal funds rate is still 0.75 of 1% above us, and they've got lower inflation. That's why they started to cut. But then you look at the ones that really matter. You look at Canada, you look at New Zealand, I'd argue to some extent the UK as well. They're more comparable players. They're a mile away from us in terms of where we sit. So on an average basis, so the world x the US, you can see it's sitting at 3%. We're sitting at 3.5%. On a headline basis, we're at 2.81, which Ben's already told you, but the group of the world excluding Australia is sitting at 2.05. We're talking about 0.8 of 1% difference between the inflation rate of the world and where we sit. So we are a long way away from the same story that they've been talking about. So that's the first thing to look at around the inflation story. The second one, which I know Ben's going to love, because that's this chart here. We talk about property. That's obviously what we do at Empower and is what we do at More. Have a look at that little sort of lime green or aqua green bars in the middle. That is the housing component of the overall total inflation. So I've deliberately done headline here that you can see that what the RBA can control is things like good pricings and particularly things around housing. Ben would have been talking to you and has been talking to you for years about the massive spike in construction costs, the massive spike that we've seen around housing costs. That also includes rents, but you can see where it sits now, right? It is now 0.6 of the total group of that 2.88% in total inflation. And it's now back to basically what you can see back 2016 through 19. It's pretty standard about where it's at. It's the other stuff that's still the problem.
Yeah, it is. I mean, look, they're all trending in the right direction, but to your point, it's definitely a challenge. I mean, sitting at that sort of seasonally adjusted year-on-year figures, I'm hoping, Evan, in terms of my case for a rate cut early in February or even the second meeting that we see in April, that once I start subbing out, these back numbers and I'm rolling my four quarters forward, that I'm going to see that particular story. And I've got my other case when we get there as well in terms of which we'll put a little wager
actually,
on.
before you change, I
Yes.
think it's a perfect point. Before you move off, when we talk about year-on-year change, Ben's right. You've got to remember it's the 4 quarters that have happened. And so those big bars roll out. So you can get these dramatic declines. And a lot of people will highlight that, we're about to roll out of a fairly dramatic period. And, the third quarter of last year was still quite a large inflation read that will drop out. And so there's no doubt it will come down again. The forecast is 3.5% for the last quarter of the calendar year. So let's see who's right, shall we? Keep going.
I love it. I think it's definitely going to be interesting for sure. Okay, so let's now have a look at the sticky inflation because this chart brings home your message in terms of what you see around. I mean, it's clear as day on the chart there where sticky inflation is currently sitting.
I've realized we haven't done this. We haven't defined what sticky inflation is. So let me just redefine that for you out there in terms of listening and viewing. So sticky inflation, applying what the Atlanta Federal Reserve uses, which is prices that take 3 or more months to move. That's why they love to highlight things like hairdressers and dentists and those kinds of things, because those businesses normally try and absorb short-term price movements because they don't want to hand it on to you and me because they're worried they're going to lose you as a customer. That's why it's such an easy way to explain using those two unfortunate service providers. They're not the only ones. Let's point that out there, but they're an easy point to.
Yes.
So that's why they're referred to as inverted commas sticky. Because the other thing about them is that not only are they slow on the way down, they're slow on the way up. And you can see how sharp the non-sticky inflation chart is. It's much, much sharper, much more dramatic than sticky inflation. But at 4.45% at the current rate or slope of decline, they're not going to get sticky inflation back to the top of the band at 3% till around about the third quarter of next year. And that's the concern. That's my concern, is that I was very much believing that the way that it started, and you can see at the top of the peak of it, that it started declining quite rapidly, that it was going to actually go back to trend quick. It hasn't. It's stuck to its name, excuse the pun, and it is being sticky. And it is not getting to the level we need it to get to. So this is what's catching my attention and why I am worried that the market, the economic world, and most pundits out there are going to do the US for us in 2025. Expect it to happen early.
The other example that you were saying before, I mean, financial services, 6.4%, in terms of the quarter. So that is another classic case of a sticky sort of industry that doesn't move their prices too much. But obviously when wage cost and competition for talent comes in, then that pushes up the cost and you either pass it on or you absorb it in profit. And so that's, again, why we say consumption. If we don't consume, then that forces business to be more productive. It also forces people into the unemployment ranks as part of that productivity. But we just haven't seen that because we've also seen government, now employing more people than they've ever employed, in the history of Australia, in terms of that particular story. So there's definitely some arguments in terms of why, inflation has been a lot stickier and sort of more persistent because we've also got record, federal spending and also infrastructure spending, which comes into that sort of wages and that unemployment story. If you had said to me 2 or 3 years ago we did 13 rate rises and I didn't see a 5 in front of unemployment, I would have said, you're crazy, something's wrong here. But ultimately, that's not
I'd even
what
argue
happened.
6.
Yeah, so now let's move on to life admin.
So the reason I wanted to show this is one that I showed at the Pippa event when I did that last week. And it was one that caught a lot of people's attention because it is quite dramatic. This is rents, property rates, utilities, automotive fuel, urban transport fares, insurance, childcare. So I spoke about childcare, but Ben read out before 2 of the largest components in there at the moment are being absolutely smacked by government subsidies, or the fact that world oil prices have moved 20% over the last year. So automotive fuel fell 6.4% in the quarter we've just been, and utilities fell by 7%. So last quarter, life admin was sitting at 6.6%. It has now fallen to below headline CPI to 2.2. Now, that should be championed. That's what government wants to do because they want the household table discussion to see less pressure. And you can see that's why I wanted this chart to be here in that. But the caveat, as I said before, is childcare. Childcare jumped 12.6%. Now, if the government wanted to do something, and this is, again, I'm going to get political here, and I'm really sorry. The government wanted to fix a real issue in the CPI number. Childcare's it, right? Because we can see also in that same chart, that massive dramatic drop down is when they subsidised childcare through COVID. There's an argument also that if you were to do that, put it into the education system, that actually you take childcare out of the actual overall household costs, you'd increase productivity because it frees up the household to actually those that are making the decision, childcare costs the same as me actually working, so I'm not going to work.
Yeah.
You would have more people in the economy. For the government's perspective, they already take the highest level of personal income tax they ever had. They get more again on top of more people working because they can actually put their kids into childcare. It's a fascinating debate, not for here, but just a caveat I really wanted to raise as a debate.
It really is a good point. All right, so let's see what's now the market's determining in terms of what's going to happen with interest rates and where is that first rate cut coming.
Okay, I'm going to give this as 2 charts. If you're listening to it, let me just sort of explain it out. This is from the day after the CPI read last week, because that's really, it hasn't changed, so it doesn't matter. So it is now saying by the end of 2025, the cash rate will be 3.76%. Now, Ben will move across in a minute to the one that happened 37 days previous to that. This is September. That one, 37 days before, for 2025 December, had the cash rate sitting at 4.07. So 3.1%. That's 4 rate cuts from where we currently sit. In fact, technically, it's 5 because we're at 4.35%. That is how fast this has turned around. Going back to the other chart, and Ben will move it back in a minute, what's also catching my attention is that it is now not pricing in one solitary rate cut until June 2025. It gives you a possibility of one in February, but it is not fully pricing in the first rate cut until June. So here's our bet. What do we want to make it, Ben? $20 or $50?
$50. We'll go 50.
Okay.
We'll go 50.
So my view is that it won't happen till June for 2 reasons. We've just gone through the inflation rate. The next inflation read is due to drop on the 30th or the 31st of January. It will be the 4th quarter of this calendar year. And if the RBA is right in its forecasts, and it was for the last read, they expect that the 4th quarter core trim mean inflation will be 3.5%. That will not be enough in my view. This is where the caveat gets in. The Prime Minister is likely to have to go to Government House and dissolve Parliament on or around about the first week of April. The next meeting after February is April 1st. Not probably going to happen then.
April
the next
Fool's
meeting,
Day.
Yeah, correct. April Fool's Day. What a day to have it. The next meeting is either going to be the Tuesday before or the Tuesday after that election that he calls in May. And that is why the RBA is more likely to be, as it has been under the tenureship of Bullock, to be more conservative and get more information about it being sustainably back to target and won't start cutting rates until June. That doesn't mean she won't go hard when she starts. I just think that the 3 meetings she has before the election will not be enough time to get them to reach their mandate.
Okay, so now my turn for prosecuting my argument. I was fortunate enough to listen to Elise Ellis speak last week, and she, for anyone who doesn't know, she's the chief economist of Westpac, but she also spent almost nearly sort of 25 to 30 years in the RBA, and for pretty much about the last 7 or 8 years, she was an assistant governor there. So she has certainly a bit of an insight into that. Now, their prediction obviously is for a rate cut in February, and they're actually predicting that the neutral rate. So looking at this chart here, you can see where the neutral rate sort of starts to sit in sort of the new predictions here for March. These financial markets, they move around a lot. They're a lot more sensitive in terms of that. But she saw that the neutral rate would actually come down to around 3.2-ish as part of that. So they see 4 rate cuts next year. Now, part of my argument to this is we know that in terms of these movements take time to flow through the economy. And so we know that the mandate of the RBA in terms of how they can flex monetary policy is to also try and achieve full employment. So I'm taking the view that they would be looking at the quarters that are falling out and then starting to think about basically whether they've broken the back on it. And even though it's not, they've got to be, to your point, sustainably confident. That's why we'll see no more rate cuts this year. But effectively, I'm arguing that we'll see a softish Christmas. And I feel like from the back of that, they know that it's going to take a little bit of time. And so they might just do the 1, maybe 2 in the sort of first half of next year. But even if they just do 1, that in itself is a signal enough. It'd be crazy to do it this side of Christmas because it'll be stimulatory from a sentiment point of view. So I think they will wait, but people are starting to hurt. We're starting to see that. So my view is that there'll be 1 either in February, and if I'm wrong there's your 50. But if it's not February, I suspect they'll still want to be looking at that. They'll have month-on-month inflation data. We're also hearing stories that as part of the election promise from Labor that they'll continue with these electricity rebates. Now, again, they have to. I mean, ultimately, everyone knows that both governments have botched our electrical system in this country, and the price that we pay for electricity is shameful compared to our competitive developed Western nations. It's sort of 33, 34 cents a kilowatt, as opposed to our competing nations like the US or somewhere else where they're paying 12, 13, 14 cents a kilowatt hour. So we're just uncompetitive, but that's because of, again, don't get me started on the Greens Party. Don't get me started on the inaction that's happened across all political aspects of that. So that's where I sit. Obviously, we've still got one more economic and RBA update to do in December, but you can see where we're at with that. And so obviously from today's discussion, we wanted to talk about the interest rates. Now, we know that the RBA board met today and it was well predicted. So there's no reason to even think that there was going to be a rate cut. So the cash rate remained on hold at 4.35%. It is the right call for now. I know how much some people in the economy are hurting, but ultimately it is the right decision because we know sustained inflation or embedded inflation is a horrible thing to have in your economy. And it obviously, sort of lessens living standards, and sort of general conditions and wealth over the long period of time. So we do need to get it down into that target range and have that lower inflation for longer. But I'm arguing that because they've got that trying to hold on to as many jobs as possible, that they might drop the interest rate in February. All right, let's move along now and let's start to talk about the unemployment story here. We'll move it along through unemployment. So we saw the seasonally adjusted unemployment rate stood at 4.1% in September. This is another argument to your end, Evan, in terms of it was a solid number in terms of what
flawless
we saw there.
Is the word. Flawless was how good it was.
That's how strong it was, right? So the unemployment of individuals dropped by 9,200 to 615,700, with those looking for full-time work falling by 13,900 to 405,500, while those seeking part-time work increased by 4,700 to 210,200. In the meantime, the employment numbers rose. This is the number we were talking about, flawless, 64,100 to 14.52 million. And that was easily surpassing the consensus of 25,000 gain after the downwardly revised 42,600 gain in August. Full-time employment jumped by 51,600 jobs to 10.03 million, while part-time employment grew by 12,500 to 4.49 million. The participation rate, which rose to a fresh high of 67.2. You mentioned that earlier, Evan, in terms of in September. This is above the consensus of 67.1. I think Elise Ellis was saying that this is the best in 100 years of data.
Yep.
They have been measuring this for a very long period of time. So that's an extraordinary result. The unemployment rate dropped to, the underemployment rate dropped to 6.3% from 6.5% in August. And additionally, monthly hours worked in all jobs advanced by 5 million or 0.3 to 1.968 million hours. And that's a productivity measure. So that is a better sign in terms of trying to get more done for less, which is disinflationary as part of that story. Let's now quickly have a look at the consumer sentiment. We can see that the Westpac Melbourne Institute Consumer Sentiment Index rose by 6.2 to a reading of 89.8 in the October, and that's up from obviously 84.6. You can see in the chart all of the subsections there. So if you want to spend some time, have a look at that. Time to buy a dwelling has moved in positive territory. So just general sentiment where I think people are realizing that the risk of a rate rise is now behind us. And so but we're still, remember, we're in pessimistic versus optimistic. A reading above 100 is optimistic versus pessimistic. So we've moved through that difficult period, but now it's just a wait and see moment in terms of when the RBA governor feels like the time is right to actually move the cash rate. And we can see here in terms of the business confidence, we saw the NAB business confidence index rose to negative 0.2 in September, down from the revised negative 0.5, amid notable improvements in retail and recreation and personal services. We saw that in the data as well in terms of recreational. Inflation was kicking back up. However, it was the second consecutive month of negative readings, with the figure remaining below average or its long-term average. Meanwhile, business conditions strongly rose, 7 versus 4 in August, buoyed by increases in sales. And this is the stuff I wanted to say before, which is really interesting. Sales, which is 12 versus 8. Profitability, 5 versus 2. Employment, 5 versus 1. So businesses are still making profits. And with that, that sort of price sensitivity, or that inflation psychology story that we've talked about many times in the past, can still be there. So this does support your argument, Evan, in terms of seeing,
I'll be very happy to take you $50 off you.
In terms of industry conditions, were noticeably higher in manufacturing, recreation, and personal services, retail, and wholesale. Labour cost growth eased. This is a good news story for me, by 1.7% in quarterly equivalent terms from the prior 1.8%, whilst a purchase price growth slowed, another good news story for me, to 1.2% from 1.6%. Simultaneously, product price growth was lower at 0.5 versus 0.7, while retail growth fell to 0.5 of 1% from 1.2. So all of those point in my favour, the input cost and the overall cost of making those good. So has the profit come from productivity and less input costs, or has it come from higher prices? That's the $64,000 question. Meanwhile, forward orders were unchanged at a reading of -5. CapEx eased slightly, 8 versus 9, while capital utilisation edged up 83.1 versus 83. So look, I think from a business point of view and from an economy point of view, when we see our GDP numbers, they're going to be sluggish. So it does feel a little bit odd. There's certain parts of the economy that are doing quite well, but it's very clear that, there is a big cohort of people in the economy who are hurting. And we're seeing that in terms of saving ratios dropping. We're seeing that in terms of people looking at private credit as part of that particular story. Before I move on to new home sales, Evan, did you want to make any sort of comments in terms of...
No, I already said, taking that employment number just as it is, like as in without completely in isolation, ring fencing it out. As I said, flawless.
Yeah.
And that's again the catch here is that you saw also in the confidence numbers. The next 12 months for family finances is almost back at optimism. It's at 99.4, right? And that's the highest it's been in almost a year and a half. All of those things, again, is what I feel we're going to do at US next year, which is we expect rates cuts to come sooner than they will. So it'll bounce around and it will happen. I'm certainly not forecasting that. I
Yeah.
just,
Yeah. Just
February,
timing.
it's just too early. It's just too early. I wish
Okay,
it
so
wasn't.
let's
I hope I pay you for $50.
yeah, that's right. You said that before. I think, yeah, everyone will be hoping you're paying the $50. In terms of one property data story that I wanted to put in the spotlight, I gave Bryce and I will do more of these updates later in the year as well. But this one resonates with me in terms of what we're seeing in terms of new home sales in Australia. We did see an increase of 3,762 units. And so units is basically the sale of a particular freestanding dwelling or a unit or a property in general. So that's what we saw in terms of the September. And that was up only slightly from 3,758 units recorded in August. Now, the context here is this is what I wanted to highlight in terms of how well new supply is actually performing. So, we also look at building approvals and all those type of things, but this is basically sales that then give the confidence to actually, have shovel ready and dig the ground and build the apartments or build the houses freestanding. So new home sales in Australia, the average is 6,853 units from 1996 until 2024. So we're just over half, about 60% of the average that we would typically do every month. So we reached a high of 16,708 units in March of 2001 and a record low of 3,004 units in January of 2023. So this dream of, we know the solution is more supply. We absolutely know that in terms of putting downward pressure on houses and downward pressure on house prices and also rents. But the reality is we're just not building them. And that means that the economics don't work in terms of why households are holding back in terms of buying new or building new. They're apprehensive about builders going broke. The whole system is broken. There's too much tax take going on in there. So there really does need to be some really clear thinking at federal and state levels in terms of how do they get out of the way and how do they incentivize the investment into new housing stock, because that is unsustainable based on the demand for housing that we have in this country and to continue to grow our economic and wealth prosperity for a country as well. So I thought I'd finish on that sort of highlight that particular or spotlight that particular chart of the month for property. And Bryce and I will pick up the property story during our regular Thursday episode on the Property Couch. So let's summarise our key takeaways of the Aussie market. We saw really inflation is easing, but it still needs to move a little quicker. To Evan's point, if it doesn't, then we're going to see rates staying higher for longer. Timing of that first rate cut, that's the debate we just had. And so we put a little wager on the side. That's our Melbourne Cup bet. So, no bets on the ponies. We'll just take that economic bet. And then ultimately what we will see is that, supply for property is still a bit of a problem. So that wraps up, obviously, our economic and RBA update. I've got our disclaimer there. If you want to learn more about all the different services we offer, you've got Empower Wealth, which is our advisory business. You've got the Property Couch podcast, is where we do all of our education around money, finance, and property. And then obviously the More platform, which Evan is one of our great ambassadors for. It's the only place you need to run, organise, control, and run your property and your money. So check that out if you haven't already checked it out. Downloadable on both app and also web apps. So you've got mobile apps and web apps there as well. And obviously that's our disclaimer. Information is general in nature. Please, if you are going to do any type of investing, please seek out professionals to do that work. And so until next month, Evan, until the last
one
of the year, thanks for joining me today. I hope it all goes well. Until next week, until next time, remember, knowledge is empowering, but only if you act on it. Bye for now.